However, if you're like most people out there thinking that you're just going to maybe take income out of your brokerage accounts and IRAs and 401ks and navigate the unknowns with that approach, that's fine. But when you face a situation where you have unfavorable sequence of returns, it can have a severe impact on the life of that portfolio and how long it actually lasts. And it may have a shorter life than your own life, meaning you outlive the balance. And this is an example of showing what that might look like. So in the, again, up and down market scenarios, the up market being on my left in green, the difference is that this person now is relying on a 5% annual withdrawal from this $1 million portfolio. And while they're still getting the same, good returns in the earlier years, having a $50,000 draw now can still make an impact to the bottom line. And you see that being evident at age 90. Instead of 4.2 million at the bottom line, we have 2.5 million for this upmarket scenario. If we shift our eyes over to the right-hand side with the down market in brown, same thing, adding a $50,000 annual withdrawal or 5% of 1 million to service their income needs in retirement. But having unfavorable sequence of returns in the earlier years, remember, retirement red zone, the 10 years leading up to retirement, 10 years following your retirement date. If you have unfavorable returns or losses while you're taking income, look what happens to this year-end value. Ultimately, at age 82, that account is depleted to zero. So the impact of having a withdrawal while also having unfavorable market returns and the sequence of how those returns unfold can have a detrimental impact to your bottom line. And that's where it's critical to understand in order to navigate this type of risk, which is a very unknown risk. A lot of people don't think about it because we only think about the markets going up, 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 and we're never taking withdrawals, so we don't have to worry about it. It can be a game changer once you understand the risk that we face. And I think having a plan to mitigate it is so critical to the success of an overall retirement.
Yeah, a good example of what you just showed there on the case to the right was just that, a term that we use is you can't compound zero, right? So yeah, as we saw that account value decreased over time, you may have a return in the market, but if your balance is zero, that's not changing anything. You're not increasing that balance at all. So
yeah, you're actually reverse dollar cost averaging it. Dollar cost averaging obviously is when you're just contributing a specific amount over time, over a long period of time, but you're doing that contribution consistently. And as the markets ebb and flow, you're buying in with those little increments at different points in time and averaging the cost over that period of time. Well, it's the opposite. When you're taking withdrawals and you're also in a negative market, you're selling more shares and compounding the loss effect on your portfolio because you're taking a distribution and selling more shares to get the same amount of income because those shares are now worth less in that down market. So it's actually compounding the loss, which is very detrimental to the success of that portfolio long term.
Yeah, and then that just brings us right back to the point of the value of that guaranteed lifetime of income and that what it provides, that having your monies in the market just isn't capable of doing. There's just no guarantee that comes with it.
Absolutely. So we talked about the role of riders in securing guaranteed income. We talked about those income riders on fixed indexed annuities. There is one other type of rider that I think is relevant to this discussion. There are a few different riders that you can have as part of those fixed indexed annuities. But when it comes to an income perspective, there is one other type of income rider, and it would be what we call an inflation protection rider. Zach, why don't you cover some of the details of an inflation protection rider and how it could potentially help somebody mitigate that risk?
Yeah, so with this rider type, what's going to happen is with that, the rider is going to adjust your annuity payments for inflation, actually. So your income keeps pace with the rising costs, In addition to that, it's really just a great way to ensure that your income maintains the purchasing power over time. What you're going to find as nature of what you'd expect, start out with a lower income that comes from that annuity, and then it will increase over time. So if we were to compare that to a guaranteed lifetime income with an income rider, a fixed index annuity with an income rider, that income will start lower with that inflationary protection rider.
Yeah. So because, these income annuities and the way that the amounts are determined are based on life expectancy from those mortality charts and some other factors, there's only 100 pennies in a dollar. So if you're expecting this income to rise contractually from an annuity for inflation, it's obviously going to start at a lower amount. And for that reason, to be fully transparent, I'm not an advocate for inflation protection riders or any of the sorts. You can even add cost of living adjustments on single premium immediate annuities. You can have it customized anywhere from 2 to 5% contractually. But what happens is when you elect to have those riders or those customizations for cost of living adjustments over time, the initial payment that you begin to receive is going to be far less than when if you were to activate the highest fixed level payment you could secure at that time. And so there's going to be a break-even point of how long it's going to take for that inflation adjustment income to reach what the highest level income would have been out of the gate. And oftentimes it's a longer period of time than what really makes sense. And so if you're looking at, addressing inflation, you shouldn't be looking at the annuity to do it all. Like it's a great product. It's a very powerful tool, but it's not really a Swiss Army knife that can do everything really well. It's used to do what it does do really well, and that is secure guaranteed lifetime income. And you should be securing that guaranteed lifetime income with the highest level fixed payment you can secure, and then use the other parts of your planning tools to address inflation. So a quick example of that would be, again, securing enough assets and putting them into a guaranteed income plan between your Social Security, a pension, if you're blessed to have one, and the guaranteed income annuity at the highest level fixed payment you can find. And then using other assets that you have to address inflation. So it could be simple as, buying CDs and using the interest from the CDs to give you a little bit of a bump every year. Or if you have those market accounts, which you definitely still should if you have the tolerance for risk at that point in time, you should have market accounts. And when the markets are doing well and you have a good return in the year, take a few points off the top and use that as your inflation buffer. And what sometimes I have clients do, is that when they have a good year in the market, earmark a percentage or two of the return and put it into a fixed rate asset from that point on. And they're building an inflation bucket separate to their general income bucket, right? We talk about buckets a lot. There's 3 main buckets in retirement planning: your income bucket, your growth bucket, and then your legacy bucket. Income bucket is your Social Security, your pensions, and your income annuities that are guaranteed to cover your essentials. Your growth bucket is then used to grow your assets over time. It can be used for leisure expenses in the future, but then it can also be used for inflation. That's that growth bucket. And then last but not least, that legacy bucket. If you don't have a legacy, you can change the name of legacy to long-term care bucket because you might need that one day. And but you have to build those buckets incrementally and do them by compartmentalizing your money and piecing off enough in each bucket to address your goals and give those buckets those intended purposes.
Yeah, and ultimately it's up to our clients to decide what risk factor goes into that growth bucket, right? So it's up to that person's discretion. If you feel that the income bucket has been handled, the legacy or long-term care bucket has been handled, then that's up to that person to decide, what they're willing to risk.
100%. And that's going to lead us into our next segment, which is our supporting research. We're not just coming and shooting from the hip with this stuff. We are subject matter experts here at Annuity Association. Annuities is all that we do. You can call us a one-trick pony, if you will, but I believe in financial planning. That's a good thing. A lot of advisors out there, they wear many hats and they try to do, in my opinion, too much, and they try to become an expert of too much. And, what's that saying, Zach, is like a jack of all trades is a master of none.
That's it. Yep.
And it's oftentimes, and the only reason I'm saying that, I'm not saying this to demean anybody or put anyone down, because I know there's a lot of very intelligent and really good advisors that mean well, but they try to do too many things in around the areas of financial planning that they're not experts in most of them. And when we talk to somebody and we start to hear their story and what they're looking for, and oftentimes they've already spoken to an advisor or two, it's very easy to hear that they're obviously already working with someone that's not an expert, because of the products they've been pitched or what they've been told or shown. And I think that's where it comes down to understanding that an expert is going to back up their claims with research from very powerful testimonies. And that leads us into our next segment, which is really looking at the research that supports the idea of guaranteed income overall improving retirement outcomes. And experts like Dr. Wade Pfau and Dr. Michael Fink have studied the impact of guaranteed income on retirement security. And with Dr. Wade Pfau being the professor emeritus of the American College of Finance, he's done some extensive research on the benefits of annuities in creating sustainable retirement income. And, he really talks about not only the economic impact in a positive way that an income annuity has on somebody, but he also talks about the psychonomic benefits to that people get from the peace of mind, and that it helps them make better decisions in the future with their money because they have the big risk already mitigated with the foundation of lifetime income. And he breaks retirement planning into retirement risks, and then he designates different tools to mitigate those particular risks. And he ties the income annuity to two main risks that are really essential to determining your outcomes. And that we talked about one of them being the sequence of returns risk. And then the second one, which is the multiplier of all of the financial related risk that we face in retirement, and that is longevity risk. Longevity risk is that retirement risk multiplier, because the longer life that you live, the higher chance you have of facing the other retirement risk. And we're talking about investment risk, taxation risk, geopolitical risk,